an economy that, at least in the U.S., while still strong in a headline sense, is not working for all people, and one where you have an ongoing challenge with artificially low interest rates and stubbornly higher inflation. So I think we have an interesting set of circumstances to navigate. I'm not, as you know, a doom and gloom guy. I believe that the world will be a substantially better place ex-war 20 years from now than it is today. But I think we have some challenges to get through in the next 2 or 3 years. And I think investors need to keep those challenges in mind.
On this episode of the What the Finance podcast, I have the pleasure of welcoming back Rick Rule. So Rick is the former president and CEO of Sprott US Holdings with decades of experience in investing specifically in the commodities space. So Rick, thanks so much for coming back on the podcast.
Anthony, it's a pleasure to be here. Thank you for giving me another opportunity to talk with you to your audience.
No problem. I think what you spoke about last time really resonated with them. So I was happy to have you back. I really enjoyed the conversation. So looking forward to this one. But yeah, as I was saying before, where I really like to start with all of our guests is starting very broad. So sort of what are you currently seeing, I guess, in the market and the economy in general? And you can take this wherever you want.
Well, the macro environment is pretty interesting. We need to understand that we have at least 2 hot wars going on. First of all, Russia and the Ukraine, and Israel versus the rest of the Middle East. And despite the fact that those things haven't impacted us directly in Western Europe and North America, there are certainly things that impact the world economy, and there are certainly things that we need to consider as risks. The second thing, of course, is an upcoming U.S. election. From my viewpoint, between 2 bad candidates, but that's a different issue. And the third, I guess, is an economy that, at least in the U.S., while still strong in a headline sense, is not working for all people, and one where you have an ongoing challenge with artificially low interest rates and stubbornly higher inflation. So I think we have an interesting set of circumstances to navigate. I'm not, as you know, a doom and gloom guy. I believe that the world will be a substantially better place ex-war 20 years from now than it is today. But I think we have some challenges to get through in the next 2 or 3 years. And I think investors need to keep those challenges in mind.
Yeah, lots of places to go there. But I'd be interested to hear your thoughts on, I guess, why do you think, you mentioned low interest rates there. Is that really the main driver of why we've seen this sort of massive divide between, the 1% and basically the rest of the population? Or what are your thoughts there?
I guess there's 3 reasons. I think one reason is artificially low interest rates. If you had free market interest rates, if the Fed didn't set the interest rate in the US, but rather the market set the interest rate, my suspicion is that the interest rate would be 2.5% or 3% above the real rate of inflation, not the CPI stated rate of inflation. Artificially low interest rates penalize savers, middle-class savers, and they benefit investors. They benefit people that have access to credit and access to the knowledge as to how to employ it. In other words, they benefit me, but they penalize middle-income savers and people in the last 40 or 45 years who have had access to credit and the education necessarily to employ credit, at least in the period 1982 to 2022, have done very well, myself included. Those people who haven't had access to credit or haven't had the knowledge base necessary to employ it have had challenges. And those people who relied on traditional methods to get ahead, including savings, have been penalized by deposit interest rates that were lower than would otherwise have been the course. So yes, I think that artificially low interest rates have been an important part in the demarcation, the economic demarcation between the 1% conservatively, probably more like 5%, and the 95%. I think another point has been the fact that we lost sight during a period of economic boom that you had to develop specific skill sets to get ahead. You make money by delivering value to people. The service that you sell or the good that you sell has to deliver enough value to the consumer that he or she willingly parts with money. The idea that many people in the economy have is that you trade time for payment. There are a lot of people who don't have the disconnect between the utility that you create in your job and the way that you get compensated. The economy was strong enough and benign enough for a period of time that people could just show up and collect their checks. That period of time is no longer true. It was particularly true, of course, in the West. But in terms of globalization, what we've learned is that there are a bunch of people in other parts of the world who are willing to do things that we used to consider to be our sole province, and they're willing to do them better, and they're willing to do them for less money. The idea that an auto worker in Western Europe or the United States who is 55 or 60 years old can employ capital better at $70 an hour than a 24-year-old can employing that same capital in India or China is fallacious. And I think that the rank and file of the citizenry needs to reestablish the connection in their own mind between the value that they contribute at work and the way that they're compensated. And I don't think that that's true. And I think it's going to be a very rude awakening to people who haven't figured it out yet.
Yeah, okay, that's interesting. Was there a third one, or those were the?
I think those are the important
ones. Okay.
I think that there is a sad tendency by people to believe that the government is there somehow to help them. I look particularly at the United States, where I'm resident. And when I talk to other Americans, they believe that the whole panoply of social safety nets, the whole panoply of entitlements that Americans of my generation have enjoyed will continue to be available. And I think that's wrong. Sadly, the on-balance sheet liability, which is to say the debt to bondholders in the United States, now exceeds $35 trillion, over 110% of GDP. But much more challenging, the off-balance sheet liabilities of the U.S. government, which is to say mostly entitlements, Social Security, Medicare, Medicaid, federal pensions, military pensions, that sort of thing. The net present value, not the nominal value of that debt, exceeds $100 trillion, which is to say it's arithmetically unsustainable. The on-balance sheet liabilities, which are $35 trillion, grow in excess of $2 trillion a year. In other words, they aren't getting paid down, they're getting made worse. The Congressional Budget Office suggests that the accretion of the unfunded deficit in the net present value of entitlements is increasing by something like $4 trillion a year. This social obligation that we have to each other, or rather, that the spenders have to the savers, is completely unsustainable, and it won't be sustained. People who believe that the government has either the responsibility or the ability to discharge the obligations that they have to themselves or their families are in for a very rude awakening. It's not going to happen. People at your age, Anthony, need to understand that the whole collection of entitlements that my generation have enjoyed have been in some sense fraud. They've been an income transfer, in effect, to us, the people who voted ourselves all kinds of cool benefits, but forgot to pay for them. We got the benefit, and we're leaving you the responsibility. You have the right to feel aggrieved, but in addition to feeling aggrieved, you need to understand that the level of benefits that we enjoyed are not going to be available to you, and you need to plan accordingly.
Yeah, I think, if I look at maybe people my age, they sort of understand that. I think the challenge is maybe the people, 20 years older, sort of late 40s and 50s, where, if you think about when they're, 30, 40 years time, these pensions can't be afforded. So what happens then? That's really going to be the challenge.
Well, I suspect we're going deep down to a rabbit hole that may not be of interest to non-U.S. investors. But I think that Social Security, as an example, will become means tested. People who paid into it for 50 years, like me, won't like the fact that they're going to be excluded from it, having paid into it. But that's what's going to happen. The age will change too. Social Security begins at age 62. When it was instituted, the average life expectancy of an American male was 66 years of age. It's not any longer. So the starting period for Social Security is probably going to be some number like 70. But the most important thing to recognize is that the way that we're going to default, because we are going to default, is going to be a default on the installment plan, which is to say that we will inflate away the net present value of the entitlement. We will do what we did in the 70s. In the decade of the 70s, the obligations didn't go away, but the purchasing power of the US dollar fell by 75% over the course of the decade. If you went into the decade of the 70s with a $400 or $500 a month income, you were in relatively good shape. If you came out of the decade with a $400 or $500 a month income, what happened is that on a purchasing power basis, you lost 75% of your purchasing power, which was a very bad thing. We're shaping up to do the same thing in the next 10 years, a substantial deterioration in the purchasing power of US dollar savings and investments. And people need to understand that. The real way that we deal with the net present value of entitlements is reducing them by inflating away their net present value.
Yeah, it's a stealth tax that people feel, but then it's, the politicians don't actually have to say it.
Correct. Correct. An ugly outcome, and one that through savings and investment, you can solve on your own behalf, but it isn't something that we're going to be able to solve at all, never mind easily, for society.
What do you think the world looks like at that point when this happens? It sounds like it's going to be, do you think it's going to be similar to the last 40 years, or do you think there's going to be sort of more turbulence during that period? I don't know if you thought about it.
I mean, you weren't around for it, but I suspect the circumstance that we enjoyed, if that's the right phrase, in the late 60s and early 70s, these transitions are always tumultuous. I think, unfortunately, they're going to become increasingly violent. I think that there will be increasing, unfortunately, racial and social antipathies where people try to blame other people for their own misfortune. I think we'll get through it fine. I think the world will be a much better place 20 years from now than it is today. But I think that we have a near-term 5 to 10 year reckoning. People who are prepared for it, people who deliver value, people who have a sense of community, people who save and invest will do fine. But they will experience more turmoil, more social conflict than they do today, I'm afraid.
Yeah, and this might be going away maybe from, well, AI is going to be another thing that, as you said, the people who are going to really struggle, who want to get paid not for the value they create, but for the time, which we've all been there, but they're going to be the ones that are really going to be impacted again.
AI is going to be, it is a wonderful thing, but it's going to benefit those people who can employ it. AI can't do anything by itself. Its job has to be determined, and its output has to be monitored by a human being. Those people who have the ability to ask AI the right questions, communicate the answers, and implement the answers are going to do very, very, very well. Those people who are in effect clerks, whose job is to add and subtract, are going to be replaced. And they're going to need a way, they're going to need to find a way with their own effort and their own talent to put themselves in non-contestable roles. They are going to need to develop the skill set to add value sufficient to sustain their lifestyle. And that's going to be challenging for people who have been skilled to believe that they have an entitlement to show up and get paid.
Yeah, and I wonder if we take this as sort of maybe a step further. So if I think about what's really been a benefit for the last 40 years, it's sort of been the liberalization of markets, it's been the removal of barriers.
Yep.
But at the same time, it seems like that's actually increasing efficiency. Actually, it's almost too good. It then concentrates massively wealth to individuals who do it the best. And that seems to have been an issue globally.
Well, it was true through most of recorded history. I think we began a period post-World War II, but more importantly, post the 1970s, where we had a respite from reality. We had, as you suggest, a whole bunch of tailwinds. globalization, the increased participation of women in the marketplace, the demographic benefit of the baby boomers entering their working and productive years, the outbreak of peace, the so-called peace dividend as the Cold War succeeded. We are unfortunately experiencing the unwinding of some of those benefits. We are increasingly nationalistic, which makes everyone poorer. The baby boomers, that demographic boom, at least in the West, is busted, which will be a challenge. The productive class has become an unproductive class, has become a drag on society, which we need to come to understand. And I think that we're going to have, sadly, a reversion to mean in terms of the accretion of value to those who are disproportionately capable of adding value. Those people will benefit, and those people who are not capable of keeping pace will find that their market share, if you will, the amount of value that they enjoy relative to the amount of value that people who are more competitive enjoy, will return to historical means, which is to say extremely disproportionate.
Hey everyone, sorry for interrupting. I just wanted to extend a massive thank you to you for listening and tuning in, and for your support over these 3 years. So we've had, hundreds of guests that we've welcomed on the podcast. We've had millions of views with hundreds of thousands of different people listening in. So I just wanted to thank you. I started this as a student. I'm now currently working, and I've always done this on the side just because I have a passion for it and I've enjoyed it. And probably similar to yourself, you listen to all these, different YouTube channels and podcasts of people listening to different guests. That's how I started, and I just wanted to sort of take the plunge and be able to have the opportunity to speak to these people, and you've made that happen. So thank you very much. Just myself, don't make any money from this, and it's really a passion project. So thanks for supporting that passion of mine. If you wanted to support the channel, all I ask is if you could like, subscribe, or even comment, positive or negative feedback. I'm always willing to take constructive criticism. I'd really appreciate that. But otherwise, thanks so much. If you can believe it, only 14% of our listeners actually subscribe to the podcast. So if you can, great. If not, no problem at all. Thanks for listening, and let's get back to the show. If we look at someone who people love or hate, Trump, he's looking to maybe bring up some of these barriers in a goal to help the average person. Do you have any thoughts on the sort of tariffs and what they will do for the US economy or the global?
A tariff is a tax. If you put up a tariff, what you are asking consumers to do is subsidize inefficient producers. If you put in place a big tariff around electric vehicles as an example, so that you subsidize Tesla and Tesla's workers in the US at the expense of BYD and the Chinese, what you're really doing is you're saying to 300 million American consumers, we're going to increase the price of a car by 50% so that we can subsidize 50,000 auto workers. Tariffs are taxes, and taxes are theft, simply put.
Okay, so that's going to make it worse for the average person and for the companies, and basically.
Correct.
And I guess that it sounds like what he's trying to do is use it more as a threat to then bring people onto the bargaining table, but then there's a risk that
not at all.
It goes too far.
Not at all. Trump is entirely transactional, and Trump is playing to people's prejudices, while at the same time engaging in the time-honored practice of understanding that elections are advanced auctions of stolen property. He is trying to offer benefits to limited amounts of people for whom that benefit would be extremely attractive, at the expense of people where the cost is diverse, meaning he is trying to bribe various constituencies to vote for him, just like Kamala is trying to do. The $100,000 subsidy to black businessmen is all about buying the black vote for Kamala, just as taxes and tariffs are trying to bribe auto workers and highly paid U.S. industrial workers at the expense of American consumers. Both parties are doing it. It's outrageous, and it's highly effective.
Yeah, and they probably won't go through with any of them. And previously we are talking about, I guess, people who have to add value and they're going to be the ones who are really rewarded. Do you see that as well? Will capital continue to be rewarded, or do you think it's going to be more to those skill sets that really add value?
No, I think applied capital will be very well rewarded. We have lived through a very benign period, a period of declining real interest rates, a period of a declining cost of capital. And this has been good for entrepreneurs. It's been good for financiers too, in the sense that they had access to capital. But I think the real cost of capital is going to increase. I think inflation is going to increase. I think that ultimately, at least nominal interest rates are going to increase. And I think that returns on capital are going to be spottier. The people who understand how to deploy capital are going to do extraordinarily well. If for no other reason that there will be less competition in the space. The rising tide won't float all ships. If you look back to the long period of stock market stagnation that we had in the United States, for those people who aren't old enough to remember it, the period 1968 to 1982, there were certain people, Tisch, Buffett, people like that, who understood how to deploy capital. And they enjoyed 20 and 25% compound internal rates of return when people in the broad market were enjoying 1 or 2%. So I think that the rewards to capital will, again, increasingly be disproportionate and allocated to expertise rather than a circumstance where everybody benefits because the wind is in everyone's sails.
Okay, that makes sense. So if we go to, I guess, markets now, obviously commodities is where you focus. We've seen sort of a bit of a pull up in a lot of base metals, specifically because of this China thought of stimulus. Is that something that you see continuing? It will be because of China, or do you think there's going to be other factors playing into it?
I'm a China bull in the very long term. When you go to China, you can't help but be impressed by tens of millions of hardworking people who save 50% of post-tax income, educate themselves continuously, educate their children. You can't help but be impressed by the level of capital investment that takes place in China and the amount of infrastructure investment that takes place in China, particularly compared with Western Europe and North America. The challenging part of China is that it's an autocracy. There's 10 billion people who run a country of 1.4 billion people. 10,000 people can't have access to enough information to do that. So the possibility of mistakes, given that concentration of power, is huge. And the opacity in the Chinese system scares one. So while I'm a very, very, very optimistic long-term bull, by long-term I mean 10 and 20 years around China, I'm near-term afraid that the growth rate will slow and they will face increasing challenges, particularly social and political challenges, but also credit challenges, because I think the allocation of capital in China has involved too much politics and not enough utility. And I think that will give them problems in the next 5 years. There have been, I think, regional overinvestments in real estate. And I think they need to work their way through that. And I think that the opaque nature of credit in China needs to resolve itself before the rest of the world can rely on China to be the growth engine that it was sort of beginning in 1990.
And when you say opaque credit, is that sort of the shadow banking as well as the government funded banks loaning out everywhere? Or
yes,
what do you mean
yes,
by
and yes. The allocation of state funding is opaque. The allocation of the banks, including the private banks, many of which are sub rosa state funded, extremely opaque. And the non-bank financial sector is opaque. A lot of the lending apparently is politically or crony inspired. Some of that money has been invested well. Not all of it has. And there's probably going to be a reckoning in the Chinese system. I'm highly confident that the Chinese will get through it. There's a lot of liquidity in China, and there's a lot of surplus generated. Until Americans, among others, cease to want to buy reasonable quality, inexpensive Chinese goods, there will be substantial economic surplus generated by China. And if they manage not to waste all of it, and if they cure some of their bad habits, I think the future in China is extremely bright.
Okay, but then in the next 5 years or so, I guess, there's lots of talks of base metals doing well. They've been basically the major consumer of those over the past 15 years.
Base metals resources are going to do well for a different reason. We have underinvested in productive capacity in industrial materials, oil and gas and base metals for 30 years. That's okay because we overinvested in them in the 70s and the 80s. So we're living off the surplus that was generated from a period of overinvestment. But that period's over. We are living as a species off oil fields and copper mines that are as old as me, which is to say they're well past their prime. And we are going to have supply shortfalls. We are still underinvesting in productive capacity in base metals, and particularly oil and gas today. And if you underinvest, if you reduce sustaining capital investments in capital-intensive businesses, you get away with it for a couple of years, 2 or 3 years. But over time, you impair your ability to produce. Look at the copper business as an example. We discovered way too much copper in the 70s and 80s. So looking for copper in the 90s, the 2000s, wasn't a great business. But because we didn't invest, we have a shortage of copper development projects. 30 years ago, the median grade of a copper mine worldwide was 1.5% copper. Today, the median grade is less than a third of that, less than 0.5%. And even at that, there's a shortage of development projects. Meanwhile, the cost to put a project in production, all costs are increasing fairly rapidly. One example would be the Resolution mine in the state of Arizona, allegedly a politically secure jurisdiction. That mine, over 1 billion tons of 1.5% copper in a place with wonderful infrastructure, in a community that's full of copper miners, has now been 26 years in permitting. 26 years in permitting. That discourages exploration for copper worldwide. It discourages development for copper worldwide. Meanwhile, we're using copper at a breakneck rate. It isn't merely increasing demand, which will happen with poor people in emerging markets becoming more wealthy. It's the fact that we have underinvested for so long that almost no matter what we do, other than a global depression, we're going to have supply shortages.
Yeah, and I think these things get held up until these shortages come, and then they'll sort of quickly get pushed through, but it'll still take too long to come online.
Now, we'll get through all this. We experienced all this in the decade of the 70s. In the decade of the 70s, the fact that we hadn't invested in extractive industry since the beginning of World War II came back to haunt us. The global growth that we experienced in the 50s and 60s meant that we had to pay the piper in the 1970s. And commodity producers, in particular in the oil business, understood that the price went up. That happened. We're basically in the same circumstance today. We've underinvested in productive capacity for a very long time. Meanwhile, global growth has continued to pace, and we have run out of an inventory of producible assets that we have in the pipeline. They're out there. We just need to go find them and develop them. And that takes time, a lot of time.
Yeah, I think something that people look past is it's not just finding them, it's actually, having it at the right return. So let's say, if it costs too much to actually pull it out of the ground, you need a much higher price to then want to invest. So for example, some oil, there's oil everywhere, but it just might be that oil price needs to be $100 a barrel versus $40 a barrel to break even.
The other thing, if I'm right, which is to say that inflation increases, means that all of those costs increase. And if inflation increases, it's not unlikely, as far as I'm concerned, that the market begins to recontrol interest rates rather than the government controlling interest rates. And if you have the circumstance where inflation is rising and the interest rates are higher, the real cost of developing productive capacity and resources goes up too. And people need to understand that. The 40-year period of declining interest rates has forestalled some of the problems in natural resources because the cost of capital has been unrealistically low. Part of the boom that we have seen in U.S. oil production has to do, first of all, with the conjunction of technologies that were appropriate, but also has to do with the very low cost of capital the oil industry has enjoyed in the United States. And if you begin to reverse that, if the march of technology, as an example, in the oil and gas business slows, or if the cost of capital goes up, or if the social rents, taxes, and royalties go up too much, you will exacerbate the supply problem and goose the prices.
Yeah, and I think the challenge as well is if prices come down in the near term, a lot of these shale producers need $60 per barrel. If it becomes below that, they're going to go out of business, and then we're going to sort of have this vicious cycle of too low production has to go up. Sure. So there's this, especially for oil, I think that's a big challenge.
That is absolutely correct. Something, as long as we're on the shale subject, that we need to understand is that although we have managed to double U.S. supply in a fairly short period of time, just over a decade, we have done that because we were able to employ several new technologies: horizontal drilling, management well drilling, three-dimensional seismic, and fracking technology. The low-hanging fruit associated with that, which is to say the Class A undrilled locations in places like the Delaware, the Permian, the Eagle Ford, are in some danger of being drilled, which is to say, without further advances in technology, we're going to be left drilling our B-grade locations, which means that the surge is over. If you combine that, and I'm not saying it's going to occur, I'm not saying that technology won't continue to increase. Maybe it will. But if we don't, and if the interest rate rises in a capital-intensive business, you could have some supply problems. One of the things that you learn in these shale projects is that the decline curves are extremely rapid. In the old conventional projects, your decline curve may have been 10, 12, 15%. In the shale projects, it's not uncommon to have 75% of the production of the well occur in 18 to 24 months. Now, sometimes you can retreat those wells and go back and increase production. But what people don't seem to understand is that without the constant application of capital to tier one locations, the production growth that we have seen can go into very rapid decline. And in the circumstance that you describe, which is to say falling commodity prices with less incentive to drill and less incentive for people to provide that capital, the fall off in production because of decline rates in these shale projects is as dramatic as the ramp up was.
Yeah, that's a great point, and I think people don't understand. It's not actually extracting oil. It's the engineering that makes the money for shale, because if you build it and it costs too much, you basically already lost money. So it's like you're trying to build it as low as possible, as efficiently as possible, pump it out, and then do the next one. Do that 10,000 times, and that's why Exxon and sort of some of the other players are the best in the game.
What you say is all very true, and people need to understand it. The exploration part of U.S. E&P is mostly gone with the incredible amount of data that we have, and with three-dimensional seismic. Roughly where the oil and gas is. As a consequence of horizontal drilling and a lot of drilling technologies, the penetration rate is up by 350%. Drilling is 350% more efficient than it was 20 years ago, which is astonishing. The fracturing technologies, our ability to custom tailor the fracturing protocol and the fluids to specific locations means that fracking itself is way, way, way more efficient than it was 20 years ago. The conjunction of those technologies is really what has led us to the boom that you describe. And to the extent that technological innovation doesn't keep pace, which is to say, to the extent that the rate of increase in efficiency doesn't keep pace with the rate of efficiency increases that we've enjoyed over the last 20 years, geology is going to become less and less forgiving.
Yeah, so if we go to gold, obviously gold prices and gold is at all-time highs. Some of the miners are sort of slowly starting to come. I think Newmont and a few others are sort of really starting to benefit from that. Is that sort of what you see moving forward, that the miners are going to start to come up, or is it really being specific in where you're looking?
You might recall our last interview where we talked about this. What I suggested is that, first of all, the disparity between the gold and the gold price was easy to understand. The central banks were buying gold, and central banks don't buy gold shares. So it makes sense that the follow-over wouldn't happen in the gold shares. But we also talked about the fact that for the gold shares to begin to participate as stocks, they had to participate as companies. And the margins that gold producers enjoyed didn't match the increase that one would have expected with the increase in the gold price. That's easy to understand, because at the same time that the price of gold went up, the price of inputs, the price of cost to produce the gold went up too. Social rents in particular have increased at 20% compounded. Labor has increased, energy has increased. What you are coming into now, however, is a period where the companies have done a reasonably good job at cost containment, and they are beginning now to enjoy the increase in the gold price and increased margins. In the next 4 weeks, we're going to have a lot of quarterly reports. And I think we're going to have a lot of upside surprises in the near term, particularly with companies that have traditionally been good on the cost side. The Agnico Eagles of the world, and the royalty and streaming companies, the Wheaton Precious, the Franco-Nevada. But I think that you're going to see it come down into the secondary tier too. You've already seen an absolute blowout quarter from Lundin Gold. And I think that you're going to see, with increasing frequency, gold mining companies on all ends of the size scale surprise to the upside with the quarterlies. The second thing that I think you're going to see, and we talked about this before too, is because of the long lead times, because we've underinvested in exploration, and because of the permitting delays, you are going to see a lot more merger and acquisition. The only way companies are going to be able to grow in the near term isn't with the drill bit, and it isn't with the bulldozer. They're going to have to grow on Wall Street and Bay Street. We've already seen mergers and acquisition through the space. And I think the pace of that, as margins increase, and as the cost of equity capital perhaps begins to fall, I think you're going to see a lot more M&A activity.
Okay, and I guess, yeah, if you go back to, this is in gold specifically, but there was Anglo America was, almost bought, or BHP was trying to do the hostile takeover. So there is these, as you said, there's these resources that people want, and people will sort of are going to start paying for them.
And we're seeing that across the resource sector. The gigantic takeover of Pioneer by Exxon, expanding Exxon's footprint in the Permian Basin at the same time that they're developing offshore Guyana. The takeover of Hess by Chevron, as you suggest, the mooted takeover by BHP of Anglo. You're seeing consolidation throughout the natural resource business. You're seeing it because margins are increasing. In other words, guys can afford to do these takeovers. You're seeing it too because there are economies of scale. Larger companies have more liquid stocks and hence higher share prices. And there's a dichotomy in cost of capital between the very large companies and the rest. The guy with a lower cost of capital wins. That's what happens. And you're seeing it too because of the long lead times that are necessary. In order for Exxon to replace production, it's difficult to do it with the drill bit. They have to do it with acquisition. And acquisitions are uniquely attractively priced now relative to both the cost of capital and the future trend, I think, in commodity prices and commodity cash flows.
Yeah, and that's possible, especially when your company is fully valued or even potentially overvalued first. And I think that's what Exxon's really good at. Using the equity once they're at that stage to grow. And I think if we go to maybe, and I'm not sure if this is mining, but I know, with my experience in oil and gas, that they're really good at cutting costs when times get hard, but they're very bad at cutting costs when times get good. And normally it's sort of the boom bust cycle in costs similar to the commodity price. And then it's when you actually see that shifting and when you see them being a bit more responsible.
Well, it's particularly pernicious in the mining business. Where you see it is during times when metals prices are low. You'll look, if you're careful, at the difference between the reserve grade, which is to say the average grade of the company's total reserve and resource package, and the mine grade, which is to say they mine the higher grade materials during periods of low commodity prices. They produce for cash. And often they account for this on a unit of production basis rather than on a reserve basis, which is to say they don't report the true depletion and the true depreciation that they're experiencing at the mine face. And what that means is that irrespective of what they do in terms of cutting costs and operations, their cost on a unit of production basis goes up because they've high-graded the deposit. This is fairly subtle, but it's something that's happened again and again and again in my career. When I look at periods of low commodity prices, and all the companies do it, what you see is that they mine high-grade material to generate cash. When that high-grade material has been taken out of the ore body, the average material has a higher cost relative to the minerals extracted from it. So that even if commodity prices go up, the cost per unit of production goes up because they've already taken a lot of the good milk out of the deposit.
Yeah, it's interesting. Not something that I'd thought about before. But yeah, Rick, thanks so much for your time today. We've sort of gone in lots of different directions. But my last question as well is, one message you'd like people to take away from our conversation?
I think what people need to take away from the conversation is that everybody needs to be much more applied in the future. Harkening back to our earlier discussion, we are coming off 40 years of very benign economic times. That means you're going to have to be a better investor in the next 10 years than you've had to be in the last 40 years. As an individual, you're less and less likely to get paid to show up. You're going to have to add value. You're going to have to be a lifelong student. You're going to have to develop your skills. You're going to have to understand that your lifestyle is going to be a function of the benefit that you deliver for others in goods and services. And as an investor, you're going to have to know more than you used to have to know. If you believe that the gold price is going to go up, and as a consequence of that, you buy the whole gold sector, you're going to buy a bunch of crappy companies. You need to do the work, not just understand that the gold price is going to go up. You need to do the work to segregate between the good, the bad, and the ugly among the gold companies. If you buy the sector, you'll go broke. If you select well in the sector, particularly during times of increasing gold prices, you will do well. But it's up to you to do it. It's up to you to invest better. It's up to you to save more. It's up to you to add value in your work. All of it's up to you. The headwinds, or pardon me, the tailwinds that you've enjoyed for the last 40 years, I would suggest are over. You can do very well in the next 10 years if you apply yourself, because other people won't make the transition to a value-based economy. But that's where we're going.
Great message. So thanks again for your time. If anyone want to find out more about your work and what you do, where would the best places for that be?
The easiest way, if you care about what I have to say about natural resources, which is the most valuable things I have to say, is that you go to my website, ruleinvestmentmedia.com, and I'll give you an incentive to do it. If you list your natural resource stocks there, I personally, for free, will rank them. No obligation, 1 to 10, 1 being best, 10 being worst. If I think my comments on any individual issue have value, I will comment. I'll talk to you about those issues. Once again, Rule Investment Media. Please, no crypto. I don't know about crypto. No tech stocks. I'm 71 years of age. I don't do tech stocks. No pot stocks. Any due diligence I did in the marijuana business is 50 years old. So natural resource stocks only, ruleinvestmentmedia.com. Love to review your portfolio for you for free.
That's great. And I think you have a, is it the masterclass coming up as well?
We do. For real serious investors, every 90 days, we do a deep dive, a boot camp. We spend 8 hours going into real detail about one subject. We've done silver, we've done uranium, we've done base metals, we've done royalty and streaming companies. This Saturday, we have one coming up on tier 1 deposits, those great big multi-asset, multi-year deposits, where if you're an investor, you can enjoy dividend streams for 20 or 30 years and participate in commodity price upside. Where if you're a speculator and you identify them, you can enjoy, with risk, tenfold returns. Do not come to the boot camp if you're a tourist. We're going to work you very hard for 7 or 8 hours. We're going to give you the tapes so that you can replay the boot camp over the course of a year, which you're going to need to do. But this is a very deep dive. This is very hard work. This is very thorough material. As I say, you'll need to repeat it. The charge for this is $99 US, which is cheap if you employ the techniques that you learn, either as a speculator or as an investor in your natural resource portfolio. But if for any reason you think you didn't get your $99 worth and you attend the boot camp, if you email me, I will refund your subscription if you don't think you got your values worth. I'm delighted to say, in 28 years of having money-back guarantees in investor education products, I've had to refund less than 0.1% of the tuitions charged. But that notwithstanding, if for any reason you don't think that you got value, you get your money's worth. The caveat to that is please don't come if you're a tourist. Please don't come if you aren't legitimately interested in a deep dive study where you work hard.
Okay, great. I'll put a link in the description below if anyone wants to find that as well as your website. But yeah, Rick, thanks again for your time.
Always a pleasure. I look forward to another discussion.
Hey everyone, thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment, good or bad feedback. I'm always open to that. But it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching and see you on the next show. And you also might like this video right here. All right, thanks again.